This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The economy and the markets have been supported by massive corporate spending on AI. With that likely to slow to some degree, there's less buffer and more room for geopolitics, tweets, and high-stakes earnings reports to make every day an adventure. Up next, we can watch headline roulette from afar, but let's stay away from the crowded table at the casino. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. I am just trying to stay sane. It's been a very volatile start to the year. We're only 5 weeks in. I'm already exhausted. I'm sure you are as well. But what's interesting is it actually hasn't been that volatile at kind of the major average level, right? I mean, the Dow, the S&P, the bond market, yeah, a little bit of fluctuation, but nothing significant, nothing more than 1 or 2% in either direction. But there is a ton of volatility underneath the surface, which we're going to talk about today. A lot of volatility within stocks, even within certain industry groups. We've certainly seen that within the tech and AI space. Lots of rotation between sectors, between value and growth. Also, of course, around the edges of the investing landscape, all kinds of volatility, silver, gold, Bitcoin, what have you. And we all know about geopolitical volatility, headline volatility. It is headline roulette for sure. So let's kind of dig into this a little bit. You know, there are a couple things that, out of all these things that I just mentioned, there are a couple things that really stood out for me over the course of the last couple weeks, maybe stood out for you as well. Silver. Don't talk about metals much on this program and really haven't talked about silver much at all over the course of the last 25 or 30 years. But amazingly, I guess it was 2 Mondays ago, I forget what the date was, but 2 Mondays ago, $40 billion changed hands in the largest exchange-traded fund that tracks silver. That's roughly 4 times the prior peak set in the second quarter all the way back of 2011. And call volumes of 3.64 million were nearly a full million above previous highs. Put it this way, silver trading on that particular exchange-traded fund almost equaled trading in the S&P 500 that day, which is the most heavily traded index on the planet. This is all according to FactSet. Amazing stuff. So maybe it was no big surprise that silver dumped out 30% a couple Fridays ago, right? Very interesting. Secondly, I found it interesting that Bitcoin, which again, I also don't talk very much about on the show, not even a registered security, but I'll just talk about it in a general sense. Bitcoin just this week broke to a 16-month low, down almost 50% from the highs, down over 15% just in the past week. Couple takeaways from this, couple lessons from this, right? You know, one is there is a difference between diversification by asset class, you know, owning bonds versus stocks versus cash, and diversification by liquidity behavior. The common thread between, you know, what we're seeing with metals right now and what we've seen in cryptocurrencies is they are as much about liquidity as anything else. They are not as liquid markets as we see with the traditional asset classes, so they're much more subject to these types of swings. Secondly, silver specifically, it's traditionally been known as kind of a monetary hedge, maybe a geopolitical hedge. I know people have differing views on that, but that's been the traditional consideration of silver and really gold as well. Some of the industrial metals, lesser extent, but you get the point. But silver has been trading like a meme stock recently. The volatility in silver is not trading the way that it has traditionally traded. It has taken on a life of its own. And when you see massive inflows like that, it can certainly lead to massive outflows very quickly. So you've got to think about these in much different terms than maybe you thought about metals, several years ago. I don't even know if they're hedges. I mean, they might be hedges to the extent that they've done well recently, metals, in the face of, a weaker dollar, in the face of some geopolitical headlines. So maybe it's a hedge from that perspective. But when you have that type of volatility, it's hard for me to really think about those assets seriously as a risk hedge, right? What we're seeing is these asset classes that are kind of on the periphery, right? Cryptocurrencies, metals, they're much more grounded in kind of sentiment than they are fundamentals. And I know the stock market can have sentiment swings as well. We've talked about that for years. But there's still some fundamentals, right? I mean, there's still earnings, there's still revenues, there's still fundamentals that we can cling to say, oh, the stock market's gotten too hot or gotten too cold. Very difficult with these other asset classes where there really isn't as much a fundamental driver, or at least a fundamental driver that you can analyze, much more about sentiment and confidence. And when those things evaporate, they can evaporate very quickly. You know, if you think of your investment portfolio as a pyramid, you know, you should have the most kind of conservative assets, CDs, your cash, your bonds, you know, maybe your house at the bottom of the pyramid. The higher up the pyramid you go, the riskier you can likely be, but you should be doing it with a smaller percentage of the portfolio, right? A lot of people these days, particularly younger people, they have it inverted. The core of their portfolio is cryptocurrency or trading speculation. I think that can end very badly for a lot of people. And then just the last thing I'll say about it, and this is more with respect to cryptocurrencies. How many times have I said, I said I think just a couple weeks ago, one, don't conflate your political leanings with your investment positioning. Secondly, don't think that you can divine what's going to transpire in the investment markets from political rhetoric or even political policy. Again, what stood to benefit more than just about anything else in the investing landscape from Trump's policies? Cryptocurrencies. He was very public about that. We are now, as I mentioned, with Bitcoin specifically, at a price below before he was even elected. Stripped out all the Trump bump over the first few months. I think there's a lesson there. All right, I'll leave it at that. But those are a couple of things that stood out for me. The next two charts I think I've shared with you several hundred times over the course of the last 20 years, but they bear repeating. One is volatility is not a symptom. You know, it is a feature of the markets, right? It's not a bug, I should say. It's a feature of the markets. We've averaged a 5% decline. Well, let me put it this way. We've had a 5% decline in the S&P 94% of the years since 1928. 94%. On average, happening every 1.1 years. This is according to Charlie Bolello over at Creative Planning. We've had a 10% correction almost two-thirds of the time, 63% of years since 1928, with one on average every 1.6 years. Well, you know, we had almost a 20% pullback last April, you know, so we're probably due for something in the 5 to 10% range. I don't know. But just understand, I say it ahead of time, because if we get some volatility like that, people go quickly to, oh, this is the end, this is over. Sometimes it's just part of the deal. It's the price of admission. Not to mention, right, this is a midterm election year. I've said several times here over the past couple months that it's traditionally the most volatile year of a four-year election cycle with an average pullback of somewhere in the mid-teens. It's also been the case with the new Fed chair, which I'll get to in a minute. But generally speaking, according to FactSet, you go back to the last 5 new Fed chairs, the first several months have been good, the time frame between nomination and confirmation, but there's generally been a double-digit pullback within the first 6 months of a new Fed chair administration. So again, I don't say these so as to make predictions, but just know that there's going to be likely some volatility this year that may or may not have a whole lot to do with the actual investment merits of the market. It might just be part of the deal. All right, so keep that in mind. The other chart I'll share with you that I've shared multiple times is that chart that if you just missed a certain number of days, what your return would drop to, with the idea being that you should try to stay fully invested if you can and not be a market timer. So this is from our friends at Strategas. They noted that over the last 30 years, so from January 1st of 1995 through the end of last year, S&P's had a compound annual return of 9.1%. So 9.1% for 30 years. If you just missed the best 5 days, So 5 days out of 30 years, your return drops a full 1.5% down to 7.4%. Missed the best 10 days, down to 6.3. I'll fast forward. You missed the best 30 days, all the way down to 2.9. So even just a minor amount of market timing. You freaked out, at the bottom of COVID, or you freaked out last April and you sold everything. Just missing a few days of recovery may have cost you 2, 3, 4% a year annualized over 30 years. So I won't belabor the point. Let's not overreact to some of this volatility that's starting to look a little more prevalent. Maybe that's the right word. But let's talk about earnings because, we've had metals volatility, we've had currency volatility, we've had commodity volatility, geopolitical volatility. But at the same time, we're also getting fourth quarter earnings. So it actually gives us a chance to hear from actual companies themselves, which I feel to be a very welcome development. But keep in mind the bar is high, right? And I've said this multiple times as well, that when you have the S&P trading at the highest multiple since the dot-com peak, doesn't mean that the market can't go higher. There's actually no correlation between starting valuations and future 12-month returns, okay? But it does mean there's less margin for error. And we're seeing a lot of this. We're seeing companies come out with good numbers, beating on the top line, beating on the bottom line, but maybe it just wasn't quite above expectations from some people. Stocks down 5, 10, 15%. Seeing a lot of that. I would really caution you against overreacting to the initial, price surge or price drop. We're seeing that a lot. Stocks drops 5 or 10%. A couple months later, it's back to where it was. Because the trajectory of the earnings matters more ultimately than whether you beat some analyst estimates by a penny or not. Okay, just keep that in mind. Don't be reactionary. And I say this because I had a client call me on Friday and say, well, geez, why did I won't mention specific names, but why did so-and-so come out with bad news? What happened? Well, the reality is they didn't come out with bad news. They beat, like I said, they beat on the top line. They beat on the bottom line. They had a lot of good things to say, but there were some quote-unquote whisper numbers that they didn't live up to. Stock dropped like 8.5% on the news. Okay? That is not a negative referendum on the long-term potential of that investment. It's a referendum on that day's trading or maybe that week's trading. Okay? Just remember that. But in aggregate, so far, we're about 30, maybe 40% of the way through earnings reporting season. Once again, earnings are better than what was expected. According to FactSet, we are currently in the midst of the 5th consecutive quarter of double-digit earnings growth. Remember last year, there was a tight correlation between earnings growth and the S&P 500 return. Well, so far, we're not only on track to finish the year around 15% year-over-year earnings growth, but guidance going forward still suggestive of somewhere between 12 and 14% earnings growth for this year. Okay? Now take that with a grain of salt. Anything could happen, but that's how things are tracking so far. I mentioned earlier that even though the headline S&P hasn't been that volatile, a lot of volatility underneath the surface. And I've used that word rotation, right? We're seeing the most significant rotation that we've seen in a number of years. The leaders of 2025 are not the leaders today. AI names are not in the driver's seat. And we saw that just this week. Stocks like AMD, some of the chip stocks down 20, 25, 30% already this year. Software names getting crushed. There's a lot of volatility there. However, the S&P still slightly positive, not by much, but still slightly positive because other sectors have picked up the baton. Energy is a prime example. If you recall, last year, I spoke about the fact that energy had averaged a 5 or 6% weighting in the S&P for the past decade. It had drifted down due to underperformance to about 3%. When a sector is either way above its normal sector weighting or way below its traditional sector weighting, that's often, I say often, not always, often a suggestion that that sector could be set up for future either underperformance or outperformance. And I said that energy, the bar was so low that any sort of good news could carry the sector. Didn't know the timing on it, but I will tell you, energy so far has been the best performing sector. In fact, according to Strategas, 100% of the S&P 500 earnings energy sector is trading above its 200-day moving average, which is a measure of intermediate term kind of momentum. Pretty darn significant. Strongest readings in a long time. Exxon, for example, strongest positive relative trend, relative to the S&P, about 2.5 years. Okay, so big things happening there. And it's not just energy, transports, trucks, freight, chemicals. Not only more economically sensitive areas are doing better, but also I would say, quote unquote, old economy stocks. So these are, chemical companies, trucking companies. I mean, these are the kind of what used to be at least the backbone of America. Those are the type of stocks that are starting to do better. Goldman Sachs came up with a pretty nice piece about how history demonstrates 3 potential paths to an extended period of kind of stock market broadening, rotation. In other words, not just a month or two, but an extended period. And these are the 3 things that have happened in the past. One is what's called a catch down. So a collapse in the earnings multiples of the largest stocks. That's one possibility. Second would be a catch up, an expansion in multiple of the other 400-some stocks that weren't leading the S&P last year. Third scenario is earnings improving for those other 490-some stocks. And when they looked at it, the catch-down decline they didn't think was all that likely. And they say this because the current so-called PEG ratio, PE to growth ratio, of the mega-cap tech stocks is about 1.4 times. That's near the trough valuation for the mega-cap tech stocks. That's near the trough valuation for those names since late 2022. So, you could certainly see some softness there. You could see some re-rating there as people get nervous about AI-related spending. But at the end of the day, I don't know if you're going to see the multiples collapse on those names. And they thought a catch-up was also unlikely because the equal-weighted S&P, if you look at all 500 stocks equally, the PE ratio, the valuation ratio for that index is still in the 95th percentile of all observations in the past 40 years. So they didn't think it was likely that people were going to pay more for those stocks. So the third option they think is the most likely option, that we're going to see stronger earnings growth, or let me put it this way, we'll need to see stronger earnings growth from those other 490-some names than the big mega-cap tech names for this broadening to continue. And Goldman Sachs is a little skeptical that that's going to happen. And I think I'm a little skeptical too. I mean, at some point, I think people are going to look up and say, hey, wait a second, why am I paying 30 times earnings for a consumer staples company growing at 2% a year and only 20 times earnings for somebody like Microsoft growing double digits? That's not the opinion today, right? Right now it's sell Microsoft, buy the consumer staple. But as we get into the year, it would not be surprising to me if things kind of flipped back the other way. And that's why I remain very open to the idea of sort of a technology comeback at some point. Tech led so much the last couple of years. They were due for a correction. They were due for a pause. But it would not surprise me if that went overboard. I mean, a lot of these tech names benefit very much from a weaker dollar. The growth in the mega-cap tech stock should still be better than the rest of the market. And as I mentioned, technology stock multiples have actually contracted over the course of the year. They've gotten cheaper. Pretty much all their performance has come from earnings growth, not multiple expansion. So listen, I'm not making an argument for loading up on tech. I think what I'm making an argument for is just keeping balance. How many times have I said that in the last 6 months? Last year, I was all about don't just chase the AI trade, right? Energy looks interesting. I mentioned healthcare a lot. Healthcare looked interesting. Financials looked interesting. Now I'd kind of say the opposite. Yeah, I'm glad you own some energy. I'm glad you own healthcare. I'm glad you own some consumer staples. But don't just dump your tech because they're out of favor, in my opinion. Again, you've got to look at your own individual portfolio to see what your weightings and concentrations are. I'm not giving investment advice on that point. But I would just say it would not surprise me if later this year things cycle back the other way. I'm not convinced that we're in for a multi-year outperformance of some of these other sectors. Last thing I'll say, you're also seeing a tremendous amount of volatility within sectors, within industry groups. Case in point, look at software. Software has had about its worst month stretch that I can really recall since maybe March or April of 2000, the unwinding of the dot-com bubble. Essentially, the market believes that AI programs are eating software's lunch. Now, that may be overdone, but I think that's another theme for this year, that you're going to see more dispersion. I talked a couple weeks ago about the dispersion within the Magnificent Seven. Some of those names have done much better than others, unlike a couple years ago when they all traded in lockstep. I think you're going to see more of that, more consideration of winners versus losers as we kind of move from the picks and shovels infrastructure phase of AI to the disruption phase. What sectors, what industries, what companies is AI disrupting? So you've got to be flexible. You have to be nimble. Hopefully we can offer some advice on what to think about and how to think about those things on this podcast, going forward. All right, I'm going to leave it there. I do have a couple quick thoughts just on the economy. I don't want to dwell too much in that, but there's been a lot of talk about the dollar, and it's important because the dollar, as I'll get to in a minute, does tend to influence the performance of several asset classes. But what you may not know is that the dollar was down over 9% last year. Last time it was down that much was 2017, Trump's first term year. So what's the connection? Well, Trump's policies are definitely for a weaker dollar, and that kind of comes from two perspectives. One is his, again, I'm not being political here, these are just facts. One is his hostility towards a number of our foreign trading partners, right? And how have those trading partners reacted? Well, they've onshored a lot of their capital, right? So that's probably one of the reasons why metals have done well, that there's been a selling of the dollar and buying of gold or silver with that money. Not just that, euro has been bought, pounds, yen, Swiss francs, pesos, yuan. There's been an onshoring of capital around the world that has led to a weaker dollar. And part of that as well is potentially, and I say potentially because they don't necessarily articulate things very well, but it's a conscious policy of Trump's to have a weaker dollar, potentially to kind of reinvigorate our manufacturing sector, to make it more competitive. So whether it is overtly intended or whether it's just a reaction to his tweets and stance on Greenland and other things, tariff policy, who knows? But the reality is the dollar has been in a weak regime for sure. The impact of that is kind of what we're seeing. Tends to favor international investments over the U.S., tends to favor value over growth. Commodities tend to do better with a weaker dollar, all of which we have seen. So that's something that I just wanted to mention it because the dollar comes up a lot in conversation. A lot of people don't really know. They can see it happening, but they don't know the what and the why behind it. Certainly, asset class rotation that I mentioned earlier, that has been influenced to a significant degree by the dollar. So that's something that we'll be watching going forward. The other thing I'll just mention briefly is Kevin Marsh, of course, is the new nomination for Fed chair. I don't know that he was a popular pick from Wall Street. He has a reputation of being kind of hawkish, favors a reduced, federal balance sheet, but he's become more dovish, if you will, in recent times, and I think some people are suspicious that he was doing that just to curry favor with Trump. We all know that the president wants lower rates. So I think he comes in, there's a little bit of suspicion around him, but I would just continue to make the point that, remember, it's a committee. It's very rare that a Fed chair would have the ability to differ in a major way from the rest of the committee. In fact, it's embarrassing when that does happen. The last time, according to JP Morgan, that a Fed chair was actually outvoted by the rest of the committee was all the way back in 1986. So it doesn't happen very often, but it has happened. I think the positive side of Mr. Marsh is that ostensibly he believes that the U.S. is in a productivity boom And if that continues, that the Fed can lower rates without stoking inflation. And it's hard to say that he's wrong because productivity is at the high, and by productivity I mean output per worker. It's a measure of efficiency, which also drives profit margins. Highest levels we've seen in like 30 years. And if you look at the history of it, I was reading a piece from Apollo this week, Apollo Investments. They looked at the PC adoption years and then the internet adoption years. We've only seen a small percentage of the productivity increase so far that you saw during those periods. So a lot of people think that productivity and margins can improve. Maybe that gives the new Fed chair the room to cut rates, be more stimulative from that perspective, without needing to expand the balance sheet and without triggering higher inflation. I know that's a bit of a dream scenario, but that's what people are hoping for. If that unfolds, that would be very bullish, I think, for the market ultimately. So hold your judgment on the new Fed chair. I would ignore the headlines that are trying to predict which way he's going to go. Last thing I'll say is I still think from an economic perspective, I've said this multiple times, you can talk about the dollar, we can talk about the Fed chair. At the end of the day, what matters the most is the unemployment rate, okay? And that's why you always have to be suspicious of GDP, because GDP actually does not have an employment component to it. So you can have 3, 4, 5% growth and unemployment going up. Those things are not incompatible. And in fact, that's what's happening now. If you look at the most recent GDP estimate from the Atlanta Fed, GDP is expected to come in over 5% in the fourth quarter, but employment's completely stalled out. The number of job openings is near the lowest level since January of 21. Pace of hiring tumbled to the lowest level since April of 2020. So I mention all this just to say that the hope is that some of the unemployment stalling was due to the uncertainty around tariffs, maybe uncertainty around certain geopolitical events. The hope is that maybe that can calm down a bit, particularly as we lap kind of last year's numbers, and that we start to get at least some companies going back to hiring. Of course, the additional risk would be AI. How many jobs is AI taking? Sometimes better efficiency, better productivity is coming at the expense of hiring, at least hiring humans. So I just wanted to mention those things because I know they're in the news. I know they're in the headlines, something that we're going to be paying a lot of attention to going forward. Up next, stick with me. I want to just comment a bit on some earnings reports. I'm also hosting next week. I'll have a lot more for you. I'll probably have another 4 or 5 reports to share with you next week. Up next, stick with me. Private wealth management goes way beyond picking stocks. Do you have a well-thought-out, cohesive strategy to grow, preserve, and pass along your wealth? Tune in every week as we discuss how to think about your big plans and how to become a better-informed, wise investor. Listen to us at The Wise Investor Group at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Promise, just wanted to comment on some of the earnings that we've heard so far. As I mentioned a minute ago, I'll have more for you next week. I'll be back hosting again. As I always say, if you are a client, I think you can feel comfortable that we've done our due diligence and homework and feel pretty good that these are right and appropriate for your portfolio. If you're not a client, please do your own research. We cannot manage your money through the podcast. And by the way, the names I'm mentioning today, not only do we own for a number of clients, I actually also own all of these in my personal account. So you could consider that a conflict of interest. Apple, we all know Apple, symbol AAPL. I thought Apple had a pretty impressive quarter overall. Looking at the analyst comments from Raymond James here, what they were most excited about, and I would agree, is their iPhone demand much better than I think what a lot of people had feared. There's a lot of fear that people are waiting around, for the new phone, hopefully an more AI-driven phone and not buying the current versions. Well, the numbers do not bear that out. iPhone demand was much better than expected. Broad-based strength across all regions, including, importantly, China. Remember, with the tariff environment, there was a lot of concern about China demand drying up. Not the case. China sales were up 38% year over year. Their services momentum also impressed, better than expected. By services, I mean all the things that you subscribe to, Apple Pay, the music library, all of that. Apple now has 2.5 billion active devices across the world. That's up from 2.35 billion a year ago. So even if people aren't upgrading their phones, they're still using over 2 billion devices, okay? And theoretically paying for those services. The big thing about Apple is, let's talk about the risk side of it. People are still waiting for a significant technological upgrade. You're going to get those liquid phones coming, those bendable, malleable phones. Those are coming. But what people really want to see is more AI-installed capability. They did extend their agreement to add Google's artificial intelligence program to Siri, but people want to see more. Okay, Apple has lagged. Now, some people would say they've deliberately lagged because they didn't want to spend all the money that Microsoft and Meta and Google are spending, and so maybe they end up looking pretty smart down the road, but there's still that fear that they're getting a little bit behind in terms of AI capability. So that's one thing. The other thing is they're a little bit of I guess it's a good problem to have in my opinion, but because they have so much demand, they don't have enough product on the shelves. They're having some supply constraints. Secondly, some of their components, particularly some of the memory chips, are getting more expensive, which could impact their earnings at some point. But I would say that in this most recent quarter, their earnings actually were better than expected, up to almost 49%, which is amazing for a company of their size. So I think, yes, they're going to have a bit of a margin squeeze, but I would suggest that Apple has some room there, given with how efficient they are. The other thing to say about Apple is they're not cheap. If you look at their multiple, it's roughly the 5-year average. So it's not a value stock. And, you could make the argument that Apple may just kind of hang out for a bit and grow into their valuation. But we'll see. Stock hasn't done a lot over the course of the last 12 months. Maybe there is a catch-up there like we've seen with others recently, like Meta, for example. So anyway, that's kind of what's going on with Apple. But overall, I think pretty encouraging quarter. Just wanted to mention Visa as well. That's another company that's been in the news. President Trump wanted to ostensibly cap the interest rate that credit cards charge. That really would have impacted the Visas and MasterCards of the world that rely on volume, transactions. But the feeling now is that maybe, I won't say it's dead on arrival, but he has to get that through Congress, and there doesn't appear to be a lot of political will for that initiative. So hopefully that's a tailwind for Visa. Their quarter was quite good. They beat on the bottom line. They beat on the top line. Some of their higher margin deliverables, what they call VAS, value-added services, that segment was up 28% year over year. This is from the Raymond James analyst. They reiterated that revenues this year would be in the low double digits. So, this is a company that has pretty good visibility into low double-digit earnings and revenue growth over the next several years. That's pretty darn impressive for a company of their size. On the risk side, the numbers were a bit messy because they do so much international business. Some of the currency translation was not quite as good as what some had modeled for because they hedged some of that risk. And if they don't have the hedges on right, sometimes it's not a one-for-one, dollar versus euro or dollar versus yen. So there was some messiness there. They also had to spend a lot. in preparation for a couple big events for them, the World Cup, of course, the Soccer World Cup here in the U.S. this summer, and the Olympics. Both of those things are high visibility and high current sort of transaction events for Visa, and they spend a lot of money on advertising, getting prepared for that. But again, I don't think that's recurring spending. I think that's spending that will fuel growth. The other positive on Visa is just they're trading at, according to Raymond James, about a 20% discount to their normal premium versus the S&P. So this is the cheapest relative to the S&P that Visa has been in several years. And quite frankly, the stock has done nothing over the last 15, 16 months. Really hasn't. So like we've seen maybe with Apple, Costco is another one that's kind of traded flat for a while, gives Visa a chance to grow into that valuation and maybe starting to look a lot more attractive on a valuation basis than it has been. There are certainly risks to the story. I mentioned the President Trump policy risk. Of course, there's overall economic risk, less volume, less transactions, less consumer spending. Those things are negative for Visa. So they need a healthy consumer to be successful. Just want to mention a couple others I haven't mentioned in some time, Verizon and AT&T. I mentioned earlier in the podcast, some of kind of the old world, old economy stocks are having their day again. Well, so are these telecommunication stocks. I think Verizon's up like 15% in the last 2 weeks. Haven't seen that in a long, long time. Verizon had, I think, a negative return last year, if I recall correctly. Their quarter was very interesting in the sense that for the first time in a while, they really seem to be focusing more on the bottom line than the top line. The new CEO has come in and really focused on efficiencies and cutting costs, but also returning money to shareholders. The analyst here at RJ said not only have they generated more free cash flow than was expected, they're plowing it directly back into buying stock and increasing their dividend, which was already around 6%. Okay, so this will be probably I don't have the exact percentage figure here, but if they keep growing their dividend, a 6 to 7% type yield for the cheapest name in the telecommunications space. They also had really good numbers in terms of net subscriber additions, which is kind of the key metric that people look at, and a lot less churn, mean people switching to other carriers. And we saw something similar with AT&T, not quite as much of a shareholder, kind of buyback initiative or higher dividend initiative, but similar focus on the bottom line. What we're starting to see is a kind of a more intelligent competitive environment where these companies aren't trying to undercut each other. We're seeing a much more rational pricing environment. That is very healthy. Where these companies underperform, it's when somebody comes out and reduces their prices by 20%, and then you get into a price war, and then you get into a falling margin situation. That does not appear to be the case right now. So AT&T and Verizon, I don't know if you chase the recent bounce here. Like I said, Verizon up 15% in a short period of time. But if these two settle in, if you can get a 5, 6, 7% yield somewhere in that range, and you're worried about, what's going on with tech and AI, maybe it's not a bad place to consider having some money. Again, like I said with energy earlier, telecommunications has been out of favor for some time. Maybe they're going to have their day again. We'll see. Well, as promised, I'll have a lot more for you next week on the individual stock front. We just heard from AbbVie, Eli Lilly, Google, some others. I'll try to share what we're hearing from those companies. Until then, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.